Hii Investors: How to Safeguard Investors and Banks from Defaulting Companies.
Hi to investors and stakeholders of listed and unlisted companies. I am Kottya Krishna, CEO of EIEVU Financial Analysis Private Limited, a company registered with the SEBI. I am a chartered accountant with 30 years professional experience and SEBI approved research analyst. We are into financial analysis of listed and unlisted companies' annual reports to safeguard the investors and stakeholders from unhealthy and defaulted companies. Here I go on my presentation. Welcome to the presentation on how to safeguard investors and banks from defaulting companies. Here is my disclaimer. Here I have given some of the cases of defaulted companies. There is a reason why I have given this list of defaulted companies, and that we will discuss later. 60 listed companies disclosed debt default of rupees 75,000 crore. 49 listed companies disclosed debt default of 69,140 crores. 8 listed companies have defaulted for $50.93 billion, equivalent to 4.32 lakh crores. 2,263 companies have defaulted for 1.96 lakh crores. 50 willful defaulted companies owe 87,925 crores to banks. 88 listed companies have been referred for liquidation as per NSE website. The list of willful defaulters as of 30th June 2024 spans 1,517 pages. These are the amounts defaulted to the banks. What about investors? How many investors must have been there in all these listed companies? Some lakhs of investors. What is the money they must have lost? Some lakhs of crores of their hard-earned money. When the company becomes a default company and referred for liquidation, the name of the company will be delisted from a stock exchange. The investors, they don't even know whereabouts of the company. They don't get even 1 rupee of face value of equity. That is the status of investors of the companies that have defaulted. Now let us go to who are the defaulted companies or said defaulting companies. There are two types of defaulting companies. One is intentionally defaulted. Let us take a case study. X is a manufacturing company. The bank has sanctioned 500 crores of working capital loan to the company for its regular operations, stipulating a condition that these loans must be used for the purpose for which they are sanctioned. Working capital loan is given for regular operations. It is like a blood in our human body. At least we can donate the blood sometime, 1 or 2 times, but you should not divert even 5 rupees of the working capital loan for any investment in unrelated investments. It will have its own impact on the regular operations of the company, and that should not be there. But here, we'll always have some wrong people in our society. What they do? They divert the working capital loan given for regular operations and invest in unrelated areas of investment in capital market, investment in subsidiary companies, or purchase of fixed assets. That will impact the regular operations of the company. And over a period of time, the operations of the company will be seriously affected, and the company will become defaulted, fails to service that debt, their loan account become NPA, and investors in the company have to forego all their hard-earned money. That is the willful defaulters. Now, let us go to second case. This is section 186(2) of Companies Act. This is my opinion, and it has got some base. As per section 186(2) of the Companies Act 2013, a company can invest or give a loan to other companies up to 60% of net worth or 100% of reserves plus securities premium, whichever is higher. The problem here it is that the Act is silent on source of funding, and hence the implications of application of section 186(2) is as follows. See what they say, 60% of net worth can be invested in or give a loan to other companies. Let us see how far net worth can be utilized for investment in other companies or give a loan to other companies. First is paid up capital. What consists of paid capital? Margin money for cost of project. It is deployed and cannot be invested because the investment is made in long-term assets. Working capital margin. Yes, this is the working capital margin brought in by the company at the rate of 20% of working capital requirement. And what is the working capital margin? Current assets minus current liabilities, whatever you get, that is the working capital margin. It is in liquid assets, can be used for investment in other companies, but we should not do that. As a banking industry, banks will not agree for diverting this working capital margin and investing in other companies. And if you divert this money for investment in other company, it will have its own impact on regular operations of the company. So we should not use working capital margin for investment in other company. Capital expenditure not funded by bank or institute. See, in financial institutions or banks, they don't fund some of the the capital assets, like land. Like land, they don't fund. In that case, the company has to invest in that company. That investment is there in the long-term asset, so that cannot be invested. Over. Free results. To the extent deployed in long-term assets cannot be invested. And to the extent available in liquid assets, of course, the company can go for investment in other companies. Securities premium to the extent available. Maybe in liquid asset, maybe a small amount for investment. Here the problem is, when this 186 is silent on source of funding, what will happen? First of all, there must be funding, for investment in other companies. When funding is not there, what is the money they can invest in? Other companies? Let us see. Section 186(2) of the Companies Act 2013 prescribes limits on loans, guarantees, and investments that a company can make. However, the section is silent on the source of funding for such investments or loans. Due to this gap, managements of certain companies facing liquidity constraint resort to using readily available liquid funds of working capital loans sanctioned by banks for regular operations to invest in or lend to other companies. What will happen? What is the concern? The concern is that working capital loans are typically sanctioned by banks for specific purpose of meeting the company's short-term operational needs, such as investment in inventory and receivables. Diverting these funds for long-term investments or lending to other entities violates the terms and conditions outlined in the sanction letter of banks. Let us see implications. What are the lapses in this? While Section 186 regulates the quantum of loans and investments of a company can make, it does not specify the funding source, leaving room for potential misuse. The oversight can be exploited by company managements knowingly or unknowingly, leading to financial imprudence and systemic risks. The misuse of borrowed funds, that is working capital loans, weakens financial health, leading to companies becoming sick and eventually defaulting. The ultimate burden falls on investors and banks, causing financial loss amounting to lakhs of crores of rupees. Investments or loans to other companies should protect it, not erode the hard-earned wealth of investors and net worth of banks. The list of defaulted listed companies given in the beginning is an indication for misuse of Section 186(2) of the Companies Act 2013. This is the other way how the companies are becoming defaulting companies. Or how the companies have defaulted to the banks. That is where the investors have lost lakhs of crores of their hard-earned money. The need for reforms. Given that there is possible misuse of Section 186, the government may act decisively, amend the Act to restrict companies from using working capital loans for intercorporate investments or loans. Introduce stringent monitoring mechanism to track the source of funds used for investment or loans to other companies. If the 186(2) is continued, there is no guarantee that whatever the public issue is subscribed is not going to land in a defaulting company. Be careful when you are investing in any company, just to see whether there are any diversion of funds. If that is the case, then it is a defaulting company. Now let us go to our main topic, how to safeguard investors and banks from defaulting companies. I have given 3 case studies. The first case study is here. Presentation of current assets and bank funding in the balance sheet when companies are in regular operations. This is not a format of Schedule 3 of the Companies Act. This format of balance sheet I have used to make you understand the presentation of working capital, the presentation of funds diversion, so that you can easily understand. Here it is the equity is 33 crores, secured 100 crores, raw material 30 crores, work in progress 20 crores, finished goods 40, receivables 43 crores. Why equity 33 crores has been taken? It is 25% of 133. That is the working capital requirement. As per banking norms, the company should bring in 25% towards their margin by working capital. So this is how the balance sheet will be when the company is having regular operations and there are no funds diversion for any investment and other related investments. Here is the second case study where there is funds diversion, and this is the present practice being followed by the companies whenever working cap loans are diverted and invested in unrelated investments. The companies report investment in capital market under current assets under the assumption that investment can be realized within 12 months, which is totally wrong. The actual current ratio excluding investments in present case is 0.7, indicates that the company's liquidity position is not good and is likely to become a bankrupted company. Reporting investment in capital market influences the actual current ratio of 0.7, and an investor or the stakeholder will be forced to take a wrong decision just because we get current ratio of 1.33 in case investments are considered as part of current assets. The bank trusts and takes the audited balance sheet into confidence for any further economic decision. As the fact of funds diversion is not reported or concealed on the face of balance sheet, the banks could not control the loan account from becoming NPA. Companies becomes a defaulting company, and the investors will be losing their hard-earned. To be considered for funds diversion disclosure. The investment reported in current assets should not be treated as part of current assets, as the same is not funded by the bank. Yes, this is not funded by the bank. Investments in capital market is not funded by the bank. It has no role in regular operations of the company. It is an odd asset. It is an odd asset in the current assets. So that should not be considered as part of current assets. Now let us go. Identification of funds diversion based on current assets and current liabilities in the balance sheet. I have given the same figures, whatever I reported in the previous balance sheet, so that you can very easily follow me. So bank loan at the rate of 70%, 100 crores, margin at the rate of 25%, 33 crores, current assets at the rate of, 70 crores. How it is 70 crores? Out of 133 crores, 63 crores are invested in capital market that we have not considered as part of current assets. So that is the reason why current assets are only 70 crores. Investments reported in balance sheet, 63 crores. How to identify diversion of bank loan? Yes. See, in general, current assets by current liabilities will be the surplus. That is the margin money of 25%. When the bank loan and marginal money of working capital are diverted and invested in any other asset, the current liabilities will be over and above the current assets. So whatever the amount that is over and above the current assets of current liabilities is nothing but diversion of funds. Let us see how it can be identified. So first we will go for loan amount. Current liabilities minus current assets is equal 100 crore minus 70 crores. What is that? 30 crores. 30 crores is the amount usually diverted for investment in capital market. Diversion of equity fund. So investment minus diverted bank loan, that is 63 crores minus 30 crores is equal to 33 crores. Total diversion of funds is bank loan 30 crores plus equity margin 33 is equal to 63 crores. Now let us find out diversion of funds based on current ratio of 1.33. What is current ratio of 1.33? In that loan is 1 and margin is 0.33. Suppose if we calculate 0.33 against 1.33, what we get is 25%. That is the working capital margin that should be brought in by the company. Now current ratio, current assets divided by current liabilities. 70 crores divided by 100 is equal to 0.7. Bank loan, current assets divided by current ratio into 1. What we get is 100 crore. Margin money diversion, current assets divided by current ratio. what we get is 33 crores. Now we have all the information to identify the total diversion of funds. Bank loan 100 crores plus margin money 33 crores minus current assets equal 63 crores is the diversion of funds. So diversion of funds again in another format, bank loan 30 plus margin 33 crores is equal to 63 crores. Investment reported in the current assets is 63 crores. The minus cash flows reported in the cash flow statement in Schedule 3 is diversion of funds for the year. Let us take a case study. The cash profit for the year is, let us say, what is cash profit? Profit after tax plus depreciation is nothing but cash profit end for the year. Suppose 100 crores is the cash profit. See, investments and long-term payment debts are, let us say, 140 crores. In that case, that 40 crores over and above the 100 crores of cash profit is nothing but working capital loan used for other purpose. That is the diversion of funds. Now let us see securitization of diverted loan. Whether diverted loan is a secured loan or unsecured loan, let us see. Here, current assets are hypothecated to the bank. A charge has also been created in favor of the bank, and that is the reason why the bank loans are secured. Whereas investments, they are not hypothecated to the bank. The charge has also not been created in favor of the bank. So this loan to the extent of investments is not a unsecured loan, it is unsecured loan. Disclosure of funds diversion. Loan to the extent of investment in current assets, that is 70 crores, is secured. Loan to the extent of investment reported, that is 30 crores, unsecured loan. Accordingly, the diverted working capital loan should be declared as unsecured CC limits. CC limits means cash credit limits, or unsecured working capital loan under current liabilities on the face of balance sheet. Here is the third case study where funds diversion is reported on the face of balance sheet. As discussed in previous page, the diverted working capital loan is not a secured loan. The unsecured portion of working capital loan is also being reported as secured loan in the present practice being followed, which means that the fact of funds diversion is being concealed on the face of balance sheet. The concealment or non-disclosure of funds diversion on the face of balance sheet has been giving a good support and encouragement to the defaulters in our country. The investors and the stakeholders have been paying the cost of concealment of funds diversion on the face of balance sheet for decades together. As given in the balance sheet, in the case of the loan to the extent of investments as it being unsecured loan is reported under the head current liabilities as unsecured CC limits or working capital loan, the disclosure of fact of funds diversion will be a preventive measure in the hands of banks. The banks would call for an explanation from the company. The loan account will be regularized and the company would not become a defaulting company. This is how the investors and the banks can be safeguarded from defaulting company. As given in the beginning, there have been willful defaulters and some companies have been becoming defaulting companies because of the lapses in Section 186(2) of the Companies Act 2013. There is no guarantee that your investment in the listed companies would not land in defaulting companies. No safety for your hard-earned money, and this is where Eagle Eye View is coming to your rescue. We report investments in subsidiary companies and funds diversion in our financial analysis reports of listed and unlisted companies' annual reports. You can check the status of your investment in listed companies by visiting our website. Safeguard your investment from defaulting companies. As I told you in my presentation, we report on net worth of the company as given here. Next is investment in subsidiary companies. Next is funds diversion. When there is an investment in subsidiary companies and funds diversion, it is an indication that the company is a defaulting company and likely to become defaulted companies. Please don't invest in these companies. Before investing in any company, you just log into our website, see the financial analysis of the company, and if there are these two cases are there, that is investment in subsidiary companies and funds diversion, don't invest in these companies. take care of your investment and safeguard your hard-earned money. So the final conclusion, when the factor funds diversion is reported on the face of balance sheet, the banks could control the loan account from becoming NPA and the company would not become a defaulted company and the investors' hard-earned money can be safeguarded. Let your investment do not land in defaulting companies. We respect investors' hard-earned money and this initiative is our commitment to safeguarding their investments.
Thank you for watching this video presentation. We will meet in next video. Thank you.